Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Cut to the Chase. Now today I want to talk about the euro, where the main question on investors' minds is whether it will or won't break parity with the US dollar. Now, based on a recent Reuters report, the euro-dollar currency pair avoided breaching the 1 level versus the US dollar intraday by only a whisker at the 5th decimal place. While I'd point out that the parity level itself is largely a psychological and perhaps symbolic level for the currency pair, directionally there are three key factors in Europe we'd keep a close watch on to determine where the pair goes from here. The first is the growth outlook itself. The key new piece of data published overnight was the German ZEW survey of investor sentiment for July, and this number plunged sharply lower compared to the June reading to a level that was below that of the March 2020 pandemic low. This was also significantly below the market's expectations, with the headline number dragged lower by the energy-intensive and export-oriented sectors. Now, clearly, worries of an economic recession are front and center for the euro area. Now, this data point itself was linked to the second factor, which is the risk of a significant energy shortage. While there have already been worries about lower than usual gas supplies from Russia, a key pipeline, the Nord Stream 1, is closing for annual maintenance till 21st July. Now, given the recent trend of low supplies, there are concerns the Ukraine war could result in a more extended shutdown. Germany's economy minister said the energy shortage could lead to an economic recession and a credit crunch in the country. And just to place Europe's energy challenges in context, the price of the benchmark TTF gas price has risen over 350% on a year-on-year basis. The third driver, of course, remains central bank policy and what it means for relative bond yields. Given these key growth concerns, expectations of ECB policy tightening remain relatively muted, with markets expecting European policy rates to only just turn positive in early 2023 versus expectations of rates heading to about 3.4% in the US. Now, tomorrow's US CPI inflation number remains one key milestone. As we discussed on yesterday's podcast, a number that is below or around consensus could maintain current market trends, but a significant upside surprise could cause markets to worry whether the Fed may signal an even tighter pace of policy tightening, exacerbating the gap between US and European bond yields. Now, bringing all of this back to the euro-dollar pair itself, recall the view we discussed a few podcasts ago was that the pair faced a fairly divergent short and long-term outlook. While we do expect the euro-dollar pair to be higher in 12 months' time, consistent with our lower dollar view, in the short term at least we saw room for recent euro weakness to extend. Now, clearly some of this has played out, and on a trend basis, while we believe this view still holds, any break of parity levels with the US dollar would likely shift the focus to the 99 cents level versus the US dollar as the next key level of technical support. Having said that, we do not see the break of the 1 level as being easy, given it remains a significant support level, and because several technical indicators are now argue the euro-dollar pair is heavily oversold. Now, this suggests some consolidation or even a short-lived bounce may be in the offing before the pair retests the parity level. So clearly a few technical levels to keep an eye on in the context of that macro sort of backdrop, but we'll pause there. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening. We wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.